Welcome to this Strategic Explainer. I'll be acting as your agricultural consultant today, and look, we're going to evaluate the global beef cattle industry to figure out the absolute optimal deployment strategy for your investment capital. If you're looking to diversify your portfolio with a tangible, highly resilient physical asset, you are exactly in the right place. Let's dive right in.
Now, before you allocate a single dollar, we really need to step back and ask a fundamental question. At what stage of the cattle life cycle does your investment yield the best risk-adjusted return? Because, let's be real, the cattle industry isn't just one giant monolith. It's a carefully sequenced series of distinct operational phases. Knowing exactly where your capital fits to enter and exit is the secret to profitability.
So here is our roadmap for today. We'll cover the beef investment opportunity, the production life cycle, matching strategy to your capital, financials and cattle futures, and finally, managing risks and sustainability.
Starting with Section 1, the beef investment opportunity. Let's look at the macro-level economic drivers that make beef cattle such a compelling asset class right now.
What's genuinely exciting here is the raw financial appeal of the herd. As a physical commodity, cattle give you direct, uncompromising exposure to global growth. Because beef is a universally recognized high-value protein, consumer demand scales right along with rising global wealth and an expanding middle class. Plus, physical commodities are a fantastic inflation hedge. When fiat currencies lose their punch, hard, living assets historically hold their ground. Adding these biological assets to your traditional equity and bond holdings gives you excellent portfolio diversification. You aren't just trading paper. You're investing in a tangible, constantly growing asset.
To put the sheer scale of this into perspective, we are talking about a massive, highly resilient global market. The fundamentals are anchored by the U.S., which sits securely as the absolute largest producer in the world, completely setting the benchmark for quality and pricing. Meanwhile, Brazil dominates the international trade routes as the top global exporter. This isn't some niche play. It's a vital global protein source. It provides multi-generational employment and underpins the economies of multiple sovereign nations. It is literally a foundational pillar of global agriculture.
Moving on to Section 2, the production life cycle. To invest smartly, you absolutely have to understand the biological pipeline of your asset.
Think of it like a highly sequenced manufacturing pipeline. It all begins with the cow-calf program. That's all about breeding and nursing the next generation. From there, the asset moves to the grower or backgrounding phase. This middle step is super interesting because it focuses entirely on skeletal and muscle development, driven mostly by low-cost pasture forage. Finally, the animal hits the feedlot. That's the intensive finish line where they get highly calibrated, high-energy feed for explosive weight gain right before hitting the market for slaughter.
And in this business, time is quite literally money. The duration of your holding period dictates your capital turnover. You can buy in at birth and hold through weaning at 6 to 8 months of age. Or you can jump in for the feeder phase, which takes another 6 to 10 months of steady, moderate cost growth. Need a faster capital cycle? You fund that final intensive feedlot phase, which relies on rapid finishing over a much shorter window. Every single month you hold is a strict calculation of cost versus biological gain.
All right, Section 3, matching strategy to capital. Let's align your specific financial playbook with the right program.
There is absolutely no one-size-fits-all approach here. If you're a smaller operation with lots of grazing land but maybe lower liquid capital, the cow-calf program is your sweet spot because your day-to-day feed costs stay relatively low. Got moderate resources? The grower phase offers a super flexible, low-cost weight gain model. But if you're a heavily capitalized investor looking for massive volume, high efficiency, and quick returns, you belong squarely in the large commercial feedlot sector.
You also have to strictly tailor your genetics because the breed you choose totally dictates your market output and overhead. Take the Angus, originally from Scotland. It's famous for premium meat and exceptional marbling. It's basically the target for high-end luxury culinary markets. On the flip side, you have Bos Indicus breeds like the Brahman. They offer crucial life-saving resilience. They are genetically tolerant to extreme heat and parasites, making them absolutely essential for harsher tropical climates where an Angus just wouldn't survive.
So how do we get the best of both worlds? By utilizing composite breeds, like the Brangus, which is a calculated cross between the Brahman and the Angus. Doing this unlocks a biological phenomenon called heterosis, or hybrid vigor. You're literally stacking the impenetrable environmental hardiness of the Brahman with the elite meat quality and growth rates of the Angus. It's a built-in biological hedge designed to aggressively protect your ROI.
Let's dive into Section 4, Financials and Cattle Futures.
time to look at the actual math and how we hedge our bets.
Figuring out your break-even feeder price isn't just helpful, it's mandatory for survival. First, you calculate the cost of the feeder calf. That's weight times price per hundredweight. Next is your cost of gain. This metric is huge. It includes your feed, labor, vet meds, the whole shebang over the holding period. Add those up for your total cost. Then, you systematically subtract that from your expected fed cattle market price, and boom, there's your true net profit margin.
Let's make this concrete with some regional data in Takaka. Say you buy a 200-kilo feeder steer. Your target is a 180-kilo gain over a strict 6 months to hit a 380-kilo finished weight. Based on standard cost of gain metrics and expected selling prices, that single animal can yield a precise net profit of 13,008 taka after absolutely all expenses are accounted for. Now multiply that margin by a commercial herd of 1,000 or 10,000, and you can instantly see the massive scaling power of this asset.
But listen, profit margins are never guaranteed. They can vanish rapidly if broad market prices suddenly drop. To aggressively protect those returns, we trade derivative futures contracts on the CME. You've got feeder cattle contracts for the younger calves under 800 pounds that still need time to grow, and live cattle contracts for the mature, slaughter-ready animals. Using these cash-settled instruments lets us proactively lock in selling prices months in advance. It is exactly how we hedge a physical, breathing herd against wild market volatility.
Finally, Section 5, Managing Risks and Sustainability. Because no professional strategic briefing ever ignores the liabilities.
Operationally, you have to meticulously account for wildly volatile market prices. You're constantly exposed to fluctuations in global feed prices. If corn or soy spikes, your cost of gain goes right through the roof. Then there's unpredictable weather, like brutal droughts that can decimate your pasture. And perhaps most terrifyingly, biological threats. A sudden outbreak like bovine spongiform encephalopathy, or BSE, can completely crash market valuations and literally slam international export borders shut overnight.
On top of that, the global beef industry faces massive structural environmental liabilities. Cattle digester naturally produces methane, a potent greenhouse gas drawing intense climate scrutiny. We also can't ignore the highly publicized issues of deforestation for grazing land, especially in places like the Amazon rainforest. Add in the staggering water consumption required for both the animals and their feed, plus the severe risks of land degradation and soil erosion from careless overgrazing.
These aren't just abstract ecological talking points anymore. They are quantifiable, immediate financial risks to your capital. Implementing sustainable practices, rigorous rotational grazing, and smart waste management isn't just about good PR. It is mathematically, structurally essential. It's literally the only way to maintain the long-term economic viability of your herd, dodge crushing regulatory penalties, and protect your own natural resources.
So, we've covered the entire macro opportunity, we've mapped the biological timeline, the strategic cheat code of heterosis, the strict math of cost of gain, and the very real-world liabilities. You now see the complete unvarnished picture, from cap genetics all the way to cash-settled futures. The only question left is, knowing all of this, exactly where in the herd are you going to deploy your capital to capture this opportunity? Thanks for joining me on this Strategic Explainer.